Okay, so your car insurance renewal just arrived. $2,300 for the year. You read it twice because last year it was less, and the year before that it was less again. Nothing about you changed. Same car, 1 year older, same commute, same garage, same driver. You haven't filed a claim. You haven't been pulled over. You have done, as far as you can tell, everything the insurance company could possibly want a customer to do. And the price went up anyway. So you call and a polite person tells you that rates in your area have increased and offers to review your discounts. You bundle something, you raise a deductible, the number comes down a little and you pay it because you have to. Driving without insurance is illegal in almost every state, and your state is not the exception. Most people don't even call. The policy auto-renews, the card gets charged, and the price of driving quietly resets twice a year without a single conversation. Here's what makes this bill strange. It's one of the only products you're legally required to buy from a private company at a price you can't see the inside of. A restaurant shows you a menu. A mechanic shows you a parts invoice. Your insurer shows you one number once or twice a year, and the number moves for reasons that live somewhere behind the words rates in your area. Most people assume the reasons are about them, that somewhere in a building, the company looked at your record, your car, your mileage, and worked out what you cost. That assumption is worth taking apart because almost none of your $2,300 is actually about you. Here's what you think you're paying for. You think you're paying for your risk. There's an actuary somewhere with your file, your 15 years of driving, your one speeding ticket from 2019, the fact that you park in a garage and drive 9 miles to work. They estimated the odds that you, personally, crash this year, multiplied it by what your crash would cost, added a reasonable margin for the company, and mailed you the result. Your premium, in this story, is a professional opinion about your driving. That's a reasonable story. It's how the product is advertised. Safe drivers save. It's how the discounts are framed. It's how every commercial with a talking animal wants you to think about it, and it is not what the number is. Your premium isn't a quote on your driving. It's your share of a pool, your slice of every crash, every stolen Kia, every hailstorm, every hospital bill, and every lawsuit involving every customer your insurer covers in your state, plus the cost of the enormous machine that collects the money, prices the risk, argues about the claims, and advertises the brand. Your personal record decides which slice of the pool you're handed. It does not decide what the pool costs, which is why the safest driver in America still watched their premium jump 20% in 2023. The pool got more expensive. Everyone's slice got bigger. Your clean record never entered into it. It just kept your slice from growing faster than your neighbors. By the end of this video, you're going to know exactly what's in that pool and exactly what's riding on top of it. Here's where those $2,300 are going. In 2024, for every dollar American auto insurers collected in premiums, about 64 cents went out the door as claims. Actual crashes, actual repairs, actual injuries actually paid. That's the part of the product that is what it says it is. The other third is the machine. Roughly a dime of every dollar goes to handling and fighting claims, the adjusters, the investigators, the lawyers. Another 20 cents or so runs the company. Agent commissions, salaries, computer systems, premium taxes to your state, and advertising. An amount of advertising you would not believe until you see the figure, and you'll see the figure. What's left over, around a nickel in 2024, was underwriting profit. And then, inside that claims pool, there are passengers. You're paying a load for insurance fraud. The FBI puts it at $400 to $700 a year per family. You're paying a load for the 1 in 7 American drivers who carry no insurance at all. There's a line on your policy that exists purely because other people broke the law. And you're paying, in some states, based on a number that has nothing to do with driving, your credit score. In most of the country, bad credit raises your premium more than a drunk driving conviction. Read that sentence again because nobody disputes it. The industry will defend it to your face. And at the end, we'll put this bill next to the same bill in Britain, same product, same job, where the average driver pays roughly a third of what you do. Not because of discounts, because of structure. Start with the honest part, the pool itself. Crashes are genuinely expensive, and they've been getting more expensive fast. The average bodily injury claim, one injured person in one accident, ran about $26,500 in 2023 and rose another 8% the next year to over $27,000. That's the average, not the bad ones. The severity of injury claims climbed about 20% in the 3 years after 2020, and the reasons are the ones you'd guess: American medical prices and, increasingly, American attorneys. The metal got expensive too. A windshield used to be glass. Now it's glass with a camera behind it, and after the glass is replaced, the camera has to be recalibrated so your lane-keeping system doesn't aim you at a median. That recalibration alone runs $250 to $600 on top of the glass. Bumpers carry radar. Mirrors carry sensors. A fender bender that would have been a paint job in 2005 is now an electronics repair with a paint job attached. The safety equipment that prevents crashes has made every crash that still happens cost more to repair. So the raw input, 64 cents of your dollar paying for real losses, is not a scandal. It's arithmetic. Millions of policyholders, a predictable number of bad days, an increasingly unpredictable price per bad day. If that were the whole product, your premium would be your slice of that arithmetic plus a modest fee, and this would be a short video. It's the other 36 cents, and the loads hiding inside the 64, where the bill stops being about crashes and starts being about the system that prices them. So follow the rest of the dollar. About 10 cents goes to what the industry calls loss adjustment expense, which is a beautifully neutral name for the cost of arguing. Adjusters to inspect, investigators to question, defense lawyers to fight the injury claims because the other side has lawyers too. This dime doesn't fix a single car. It's the overhead of deciding, claim by claim, how much fixing the company actually owes. Another 20-odd cents runs the business. Commissions to the agent who sold you the policy, the salaries, the software, a couple of cents in premium taxes to your state, and the marketing. In 2025, Progressive was spending more than $1 billion on advertising per quarter. GEICO, rebuilding its market share, put out close to $2 billion for the year. That is premium money that became jingles. When you pay your bill, a measurable slice of it exists to convince other people to switch insurers, and a slice of their bill is trying to convince you. And the nickel of profit? That nickel is brand new. In 2022, auto insurers paid out 112 cents for every dollar they collected, the worst underwriting year in a decade. In 2023, they were still $17 billion underwater, so they did the only thing the system lets them do. They repriced everyone. Premiums rose about 14% in 2023 and another 13% in 2024, and by the end of 2024, the industry had swung to a $14 billion underwriting gain, its best result in more than 10 years. Your renewal didn't go up because of you. It went up to repair their 2022. Now for the part of the price that isn't about driving at all. When your insurer sets your rate, it feeds a file of variables into a pricing model. Some are the ones you'd expect: your record, your mileage, your car, and one, in most states, is your credit history, compressed into something called a credit-based insurance score. Here's what it does to the number. Drivers with poor credit pay roughly double what drivers with excellent credit pay for identical coverage. The 2026 rate analyses put the gap between 98 and 118%. A drunk driving conviction, averaged across the states, raises a premium about 75%. Line those up. In most of America, having bad credit costs more on your car insurance than having a DUI. The industry's defense is actuarial. Credit scores correlate with how often people file claims. The correlation is real, and regulators in most states accept it. Notice what that argument concedes. The score doesn't predict how you drive. It predicts how you behave as a claimant. You are being priced not as a driver, but as a future filer of paperwork. 4 states looked at that and banned it. California, Hawaii, Massachusetts, and Michigan don't allow credit in auto pricing at all. The other 46 let it ride, which produces a quiet American absurdity. The same driver, same car, same record, can cross a state line and watch hundreds of dollars appear or vanish based on a number invented to predict credit card defaults. Your zip code works the same way. Not your driving, your neighbor's claims, your area's repair costs, your county's jury verdicts. The premium price is the water you swim in. Then come the passengers, the costs riding in the pool that nobody's crash produced. The first is fraud, staged accidents, padded repair bills, clinics billing for treatment nobody received, the occasional vanishing luxury car. The Coalition Against Insurance Fraud put fraud across all insurance lines at $308 billion a year in its 2022 study, and the FBI's long-standing estimate is that fraud adds $400 to $700 a year to the average family's premiums. Every fake whiplash claim that gets paid becomes a real line in the pool, and the pool is you. The second passenger is the uninsured. In 2023, according to the Insurance Research Council, 15.4% of American drivers, about 1 in 7, carried no insurance at all. In Mississippi, it's roughly 28%. Add the underinsured, and 1 in 3 drivers on the road couldn't fully pay for the damage they might do. The system's answer is elegant and absurd. It sells you a coverage called uninsured motorist. You pay a private company to insure you against the failure of other people to buy insurance from a private company. The mandate is universal, the compliance isn't, the gap is on your bill, and the third is the one you already know by name. The gecko, the emu, Flo, mayhem. Those characters exist because in a market where every policy is basically the same regulated promise, the only way to grow is to take customers from someone else. So billions of pool dollars a year go to 15-second arguments about switching. You are paying, quite literally, for the ads that ask you to leave. If you want to see what a premium really is, a stack of state-level mandates with prices attached, look at Michigan. In 1973, Michigan adopted no-fault insurance with a feature no other state kept. Every auto policy had to include unlimited lifetime medical coverage for crash injuries. Not a big number, no number. And there was a second feature hiding under the first, no fee schedule. Hospitals could bill an auto insurer whatever they chose for crash care, routinely multiples of what health insurers or Medicare paid for the same treatment. The ChargeMaster machine from your hospital bill wired straight into your car insurance. The result was exactly what the structure ordered. Michigan spent 5 consecutive years as the most expensive state in America to insure a car, and Detroit became the most expensive city, with premiums that could run several times the national average, in the city that builds the cars. On June 11, 2019, Governor Gretchen Whitmer signed a reform, and starting July 1, 2020, Michigan drivers could finally choose their medical coverage. Keep unlimited, or cap it at $500,250 or $50,000 for Medicaid enrollees, with mandated cuts to that slice of the premium from 10% off for keeping unlimited to 45% off at the bottom. A fee schedule finally capped what providers could bill. Notice what actually moved the price: not driving, not crashes. A legislature repricing one line item. Michigan drivers didn't get safer on July 1, 2020. Their mandate got smaller, and Michigan still sits near the top of the national price table because the rest of the stack is still the stack. Every state's premium is a version of this, quieter but the same species. Which brings us to the comparison that reframes the whole bill. In early 2026, the average comprehensive car insurance premium in the United Kingdom, their version of full coverage, was £560 per the Association of British Insurers. Call it $750. The American average, remember, sits around $2,300, 3 times the price for the same product category, and the gap is structural all the way down. Start with the crashes themselves. The United States loses about 13 people per 100,000 to road deaths. Britain loses fewer than 3. Roughly 5 times the fatality rate, driving larger, heavier vehicles at higher speeds on roads built for throughput. And the direction of travel split. Over the decade to 2022, road deaths fell by about a fifth across comparable wealthy countries and rose 22% in America. More crashes, worse crashes, more claims in the pool, then price each crash. An American injury claim is paid at American hospital prices, the same 4 times cost billing you've seen before, now landing inside an auto policy. It's paid with American attorney involvement in front of American juries. The British claim for the same injury settles against nationalized healthcare and capped legal costs. Same broken collarbone, different invoice, and the difference compounds across every claim in the pool. The British driver isn't buying a better product. They're buying insurance against cheaper accidents, in a system with fewer of them, argued over by fewer lawyers, patched up at regulated prices. Your premium isn't expensive because insurance works differently here. It's expensive because everything it pays for is. Where did your $2,300 actually go? About 2/3 of it went into the pool and came out as somebody's very bad day. A rear ending in traffic, a stolen car, a collarbone, priced at American repair rates and American hospital rates. That part is real, and if you're ever the one having the bad day, it's the best money you ever spent. About a dime of every dollar paid people to argue about what the bad days cost. 2 dimes ran the company and bought the commercials. The gecko is in your bill, and so is the ad asking you to leave him. A nickel in a good year stayed behind as profit. In 2022, the nickel ran the other way, and threaded through all of it. A few $100s for fraud you didn't commit, a load for drivers who bought nothing, a surcharge for your credit score, and the going rate for whatever your legislature decided must be in the policy, priced, in the fine print, by the same medical billing machine that prices everything else in this country. None of it was ever a quote on your driving. Your clean record just decides your share of everyone else's year. That's the thing to understand about this bill. Insurance is the one product you buy hoping to waste your money. And the premium is the pool's arithmetic, not yours. You're not paying for what you did. You're paying for what everyone like you might do, plus the cost of finding out who's like you. You can't drive your way out of that. You can only carry your slice.